QuickBooks Pro Desktop 2021, adjusting entry depreciation with the help of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're going to be opening up our reports by going to the reports dropdown, company and financial, taking a look first at the balance sheet. We'll change the dates up top, or the date up top, to 02/28/21, and then we're going to open up our income statement, profit and loss, and we're going to go to the reports drop-down to do so. Company and financial, we'll take a look at the profit and loss standard, changing the dates from 01/01/21 to 02/28/21. There's our income statement. I'm going to go back to the balance sheet here. We're talking about depreciation this time. When we're thinking about depreciation, we're thinking about the depreciable assets. I'm not going to get into a lot of detail on how to calculate depreciation. We do have a course on that if you want to take a look at that. But what we want to focus in on here is the play between what the bookkeeping process is and the adjusting process, and possibly the help of other software to help you out with the calculation of the depreciation, and working with possibly a tax software or accounting firm in order to do so. So let's just consider the accumulated depreciation here. It's similar to what we did with the prepaid insurance, in that when we purchase the equipment, whether we finance it or not, even if we purchase it simply for cash, we will typically not expense it at the point of purchase. In other words, if we purchase something, the most obvious example is like a building for like $300,000 of cash, we wouldn't just expense the cash, even if on a cash basis of like building expense, at the point in time of purchase, because that would really heavily distort the income statement. If I compared the current month to the following month after having a $300,000 expense for the purchase of building, then I wouldn't have a good comparison, because I'm using that building in the future for future use. So it would be better for comparison purposes on an accrual basis to put the building on the books as an asset when purchased, as opposed to expensing it at the point in time of purchase. So we're going to put large purchases on the books as an asset. Typically, that's going to be our practice on an accrual basis. Even if we use a cash basis method, we will typically still do that. And then we're going to allocate the expense or the cost over the useful life of the equipment in a similar way we did with the prepaid insurance, which we purchased before we used it, and then we allocated the expense over the use of the insurance policy as the policy expired. Now, there's going to be a bit of a difference for prepaid insurance and property, plant, and equipment. With prepaid insurance, we simply decreased the prepaid insurance and recorded insurance expense at the point in time that we were consuming or using the insurance. We'll do a similar thing down here for the furniture and fixture. However, we're not going to decrease the account itself, meaning, for example, furniture here, I'm not going to decrease furniture itself and then record furniture expense on the other side. We're going to do effectively the same thing, but call it something a little bit different. We're going to create another account. It's called a contra asset account, called accumulated depreciation. And we're going to use that account to tell our reader more than one thing. It's going to tell our reader, hey, look, this is just an estimate. The furniture and fixture that we bought is on the books at the cost. We don't know how much it's decreased in value by. All we can do is estimate how much it's going to decrease in value by, and then we'll use depreciation to record that estimate, accumulated depreciation to record the accumulation of the depreciation over time. So that's going to be, this account then is going to show the decrease in a separate account, and then if you want to know what the book value is at this point, you would have to subtract them out, and that would be basically the book value. The other side is going to be an expense, but it won't be furniture expense. It'll be depreciation expense. That's going to be the basic concept that we will be using. Now, if we double click on the furniture account, for example, and change the date up top to 01/01/21, notice that we had a beginning balance before this, prior to this year, of $75,000, and then we only have 2 items in this account, and that will typically be the case. There's not going to be a lot of new stuff that happens, because we don't buy a whole lot of large things during the year. There shouldn't be too much activity. That's the nice thing about it. There shouldn't be too much going on, even though there's a little bit more complexity to these type of transactions. Now, when we purchase the transactions, we want to think about how we're going to record this on our books and compare that to the detailed information that we're going to need to calculate the depreciation on. For example, the $75,000 that we started out with represents all stuff that we had in the account before this year. Now, that's just one lump sum number, but I need to break that out by category of equipment so that we can then track the equipment, depreciate each individual unit of equipment. Now, oftentimes you'll use other software to do this, and oftentimes you might be working with your CPA firm or tax software to help you to do that. The tax software can calculate both books and tax depreciation oftentimes. So with depreciation, I would definitely think about, or definitely talk to your accountant and ask them how you want to deal with equipment and the recording of accumulated depreciation. If you try to do it yourself, then you're not really eliminating the need for the tax preparation software to do it as well, because they're going to have to do tax depreciation no matter what. So the fact that the tax software needs to do depreciation on a tax basis already might make it an ideal place, which it often is for many companies, to get the detail. Use the tax software to break out the detail of this information, and then ask for the journal entry and just record the summary journal entry here in QuickBooks. For example, that $75,000 there, if I look at a depreciation schedule, this is just a mock schedule from the software. It's 2020, but we're imagining it's 2021. Tax software is not out for 2021 yet, so 2020. And we're going to say, here's the detail of that furniture and fixture. We're actually breaking out the items, sofas, chairs, recliners, and whatnot, that will be included. You don't want to put it on the tax software, even if purchased at one time, as just one lump sum number. Because you're going to need to basically depreciate it possibly differently based on when it was purchased. And two, if you sell this stuff, like if you sell the sofa and you grouped it all in the depreciation schedule as just $75,000 worth of stuff, then you're not going to know which one you sold, right? So you need the depreciation schedule so you can calculate the gain or loss on the item you sold. So that's why whenever you add new equipment, you want to just record the purchase in QuickBooks, and you also want to give the detail and possibly even like serial numbers and whatnot, if it's a car or something like that, to the tax preparer, so that when they make the detailed schedule, you know exactly what piece of equipment you're talking about. If I go to the schedule and say, hey, here's the coffee tables, I should be able to point exactly to where those coffee tables are. If I went to physically into the place and looked for them, I shouldn't have a problem finding them. That's the hope that you can have, so that when you sell them, you'll know which items you sold, and you can easily take them off the depreciation schedule at that point in time and record any gain or loss related to it. So this is where the detail, and this is generated from tax software, which again, I think would be a common place for people to be looking at. So for example, if I look at everything in the prior year, which I'm going to say is 2019 here, we're working in 2021. So this is kind of a year back because this is the latest software that's out right now. But imagine this is 2020 and then the current year is 2021. That's how it is in the QuickBooks system. So 2019 is the prior year. If I took this and said we have 15,000 plus the 23,000 plus the 12,000 plus the 5,000 plus the 2,000 plus 3,000 plus the 7,000 plus the 8,000, there's our 75,000, which is in QuickBooks at this 75,000, our beginning balance. Again, breaking out that detail. So all you really need in QuickBooks is the summary data, and you need to provide the tax software, whatever software you're going to have for the more detail, with the detailed information, which from year to year should not be much because you don't make a whole lot of large purchases from year to year. So it could this schedule looks quite intimidating, but if you just look at the changes from year to year, it should be not all that intimidating. And then also note that the depreciation schedules could differ from tax to books. So a depreciation schedule for taxes might look something like this. We'll typically use some accelerated form of depreciation, a maker's depreciation. And you also might see things like a 179 deduction or special depreciation. So the tax depreciation, notice, is usually accelerated even past an accelerated book depreciation. So when you're talking about how should I record depreciation with your accounting firm or your tax firm, you might want to ask them. Some companies will put their depreciation schedule, even for book purposes, on a tax basis. Why? Because then you don't have to track two separate depreciation schedules, which is a little bit easier. However, the tax depreciation is not in alignment with the goals of the book depreciation. Book depreciation goals are to report things accurately. Tax depreciation goals include goals like the tax from the law, which is to stimulate the economy and do other types of things as well. So for simplified, for ease purposes, you might just say your tax professional, your CPA firm might say it'll be easier just to record on tax depreciation and not have this difference we have to deal with. Or you might say that I think that difference is important to my decision-making process, and I would rather you not only provide me with the tax depreciation, which you can see here, prior depreciation was at $10,719 for taxes, and for the books it's at $7,500. So it's quite different for book and taxes. And you could say I would like you to record book depreciation based on possibly like straight line depreciation possibly, as opposed to the double declining, and we're not going to have any special depreciation or 179 depreciation with book depreciation. So if you do that, tax software can typically do that. It can print out both schedules, but you'll typically have to ask your CPA firm or your tax firm for those schedules and discuss how you want to deal with depreciation to get those. Okay, so this is going to be then we have the depreciation for the prior year, which was at $7,500 reported here in the prior year. Again, this is 2019 and 2020 instead of 2020 and 2021. So the prior year here we're saying is 19, where the prior year in our system is 2020. So just be aware of that. So I'm going to go back on over here and say, okay, let's close this out. And we're going to say, okay, that's the 7,500. That's what we have in there before we record the current year's depreciation. And then the difference between the two is that 90,500. So we got the 90,500. So that looks good. And then in the current year depreciation, we have the full year is at the 14,001. Now then the next question is, do you want to record depreciation monthly as you go, which could be a little bit more cumbersome to do if you're working with tax software? You might just want to accumulate upwards all the transactions that you have. For example, all these transactions I'm going to change this 010121, and then give them to the tax software or the accounting firm at the end of the year and simply record depreciation expense yearly. That'd be the easy thing to do. But if you want to record it monthly because you need it, you think it's relevant to your decision making, then you can give them the information every month and ask them to give you your updated depreciation calculation, and you can calculate that. So we're going to have a 2-month time period. This software is designed to record it yearly typically. So this is the depreciation for the year. So I would take that and break it down into 1 month or 2 months that we're looking at, January and February in the current time period that we are working with. And then we have so that's the new items that we put into place. So furniture and fixture, we added these items for furniture and fixture. And again, in QuickBooks, if I look at the detail, I'll change the date again, 010121. We put them in as just two sums, 16 and 7,000, and just called them office equipment, right? We didn't give any detail. We probably want some detail, but I want to make sure I save the detail that I can provide to the tax software so they can give me examples of what it actually is, right? So the new items that we purchased in 2020, which in our system is 2021, the current year, we're saying 2020 or 2021 in QuickBooks, is broken down 7,000, the 3,000, the 2,000, the 4,000, the 5,000, and the 2,000. So we broke that out. Also note that we have the categorization here between furniture and fixture and machinery and equipment. Tax software will typically have these categorizations as standard because the tax code these categories will dictate oftentimes or give you some example that the tax code is much more stringent in terms of how you're going to depreciate certain items. So you probably want to keep the same categorizations as the tax software so that you can have the same categorizations in your books and be able to line up the categories as well. So we have the machinery and equipment at the 5,000. So if I close this back up, we have the equipment, we just called it, at the 5,000 here. So you might want to rename them and make them exactly according to the tax software. I think that'll be the easiest thing to do. I may not do that here, but just realize that. Also note, with the formatting, you could just record all of your categories, equipment, furniture, and then one accumulated depreciation account. Or you can do what we did here with the sub accounts and have the equipment, and then below it, the two accounts related to it, which will be the cost account and the accumulated depreciation, furniture, and then the two accounts below it, accumulated depreciation and the furniture. This allows you to collapse these columns too, which is nice. Also note that the accumulated depreciation and the furniture is out of order because within this subcategory, it's in alphabetical order. So the only way to reverse this, which we would like to do, would be to use account numbers. But we're not going to use account numbers now. We might show you how to use account numbers later because they can mess things up if they're not used properly. So the other thing we can do when presenting this is just collapse this and say, hey, look, that's the book value, and not give the detail of these two accounts and not show that they're kind of reversed order here. So that's going to be our transaction. So once we have this data, periodically, the transaction to record the journal entry is pretty straightforward. We record a debit to depreciation expense and a credit to accumulated depreciation, and then we're just given the number that we're going to calculate. Again, if it was a yearly number, we would just take this number. If we're recording it monthly or in 2 months, we're recording 2 months in our case, then we're going to have to break this down to monthly or 2 month time period. So that's what we will do here. Let's go to Excel. And this is by category. So this is for the furniture and fixture, and then this is for the machinery and equipment. So I'm going to do two separate calculations to do it. Let's take a look at the accounts that will be affected. We're going to have the accumulated depreciation here for the furniture. And so I'm going to highlight that. Now, we don't have one set up for the equipment because we don't have anything in it yet. So I'm going to have to add that. So if I go to QuickBooks, I'm going to look at the lists and go to the chart of accounts and just check out what it looks like in the list here. See if I have it. We have set it up here. It's going to be right here. So it's going to be above the equipment account. And it's going to look like the same format because it's a sub account. So it's going to be called equipment and then colon and then the accumulated depreciation. So I'm going to try to do that same formatting just like it has here because it's a sub account. That's what this little colon thing does. So I'm going to put it above the equipment. I'm going to highlight or select this row, right click and insert. Shift cells down. I'm going to call this equipment. So I'm going to call it equipment and then net colon ACC depre and then equipment. And hopefully I spelled that right. If I didn't, I apologize, but I'm going to keep going here. So there we have that. And then the other side is going to be in depreciation expense. There should be two accounts for depreciation. And so we'll have that down below. Now they're not here again because we haven't recorded anything to them. So if I look at my chart of accounts, I want to put them in the same order. We're going to say, all right, is there a depreciation expense account? And I go down here and I say, yes, there is one. Now, here's another question. We could record both depreciation to one expense account and just make it one generic depreciation expense. Or we can make two accounts for depreciation for the equipment, depreciation for the furniture. I'm going to go ahead and show you how to make two accounts. And to do that, I want to also make subsidiary accounts. So I'll do the same kind of thing we did here. Here's the parent account. Let's make two subsidiary accounts to it for depreciation expense related to the furniture and then depreciation expense related to the equipment. So to do that, I'm going to make two new accounts. I'm going to say new. I'm going to make it an expense account, and I'm just going to call it depreciation expense, and then I'm going to say furniture. Now notice that because it's a sub account, you could just call it furniture because it'll be under the depreciation expense. So I'm kind of being repetitious by putting depreciation expense here because it's going to be under the category here of depreciation expense. So that's a bit repetitive, but I'm going to keep it there. So I'm going to say save and close. So in other words, it's going to be underneath depreciation expense. So to repeat depreciation expense is kind of repetitive, but if I just put furniture, then when I try to find it, I could get confused with the asset account for furniture and the depreciation expense account for furniture. So I repeat it either. Okay, so I'm going to go new, another one, and then I'm going to call this an expense account and continue. And this is going to be depreciation. And I'm just going to call it expense, and this is going to be equipment. And it's going to be a sub-account of depreciation. So I'm going to say save and close. So now we have those two accounts here. Now they're right under the bank feeds. So I'm going to add those to Excel now. So I'm going to go to Excel and say, okay, it's going to be in alphabetical order. I'm going to have two accounts under the bank feeds. So I'm going to select these two rows or columns. I'm going to right-click. And I'm going to say I want to insert, and shift down. Insert, shift down. Okay. And then I'm going to say this is depreciation expense. And this is going to be, I'll say equipment. which one did they put on top here? Yeah, equipment, and then depreciation expense. I'll put furniture. Hopefully I spelled those properly. I'm going to make these green, and then I'll say these are 0 to start with, and there's our transaction. So once we have this set up, the journal entry is going to be straightforward. I'll make 2 of them, so I'll record depreciation for the equipment and then for the furniture. So let's do that. This is going to be ADJ number 6, and I'm going to say we have depreciation expense for the equipment. It's going to be the debit, and then the credit is going to be the accumulated depreciation for the equipment. And then I'm going to put a 0 here, copying that across. Okay, so then I'm going to go to my schedule here, and we're going to pick this up from the schedule. Now we're looking at the equipment. That's the second category. So we got furniture and fixture. Then we have the machinery and equipment down here. For the year, it would be 833. So we're looking at it for 2 months ended. Now again, you might say, well, we should record it as of January 31st and then another month on 2/28. But what we're doing here is trying to make this correct as of the time period 2 months ended in February. So I'm just going to make the financials correct as of 2 months ended in February. So that means I'm going to take this for the year, 833, divided by 12. That would be the monthly amount times 2. So we got that 138.83. I'm going to do the same calculation in Excel because I like to see the detail there if I need to go back for a reference. So the year is 833 for a year. So I'm going to say this equals 833 divided by 12 times 2. And that gives us that 138. There's the debit and credit. If we record this out, then I'm going to say, all right, so now we're going to go to the equipment depreciation expense, which is going to be that 138. That increases the expense here, and it increases or decreases the net income. And then accumulated depreciation is going to be up top for the equipment. This is going to be equal to the 138.83. So there we have it. That increases the contra asset, which decreases total assets, the net value 1,500 minus the 138.83 or the 136,117. If I go to my schedule over here, I'm going to say, does that make sense? Yeah, here's the total, and 5,000 minus that 833 is where we're at. Now I'm going to do the same thing for the furniture and fixture. The yearly depreciation is 14,001. So I'm going to say, all right, let's do that. I'm going to say this is going to be equal to the depreciation expense on the furniture. The other side going to accumulated depreciation. The amount then calculated as, we're going to say this is going to be the 14,001 divided by 12 times 2, 2333.5. I'm going to do that same calculation in Excel, 14,001. So this will be equal to 14,001 divided by 12 times 2. And there we have the debit and credit. So if we record that out, this is going to be depreciation expense for the furniture going up by the 2333.50. Decreasing net income, and then on the other side going to accumulated depreciation furniture credit that increases the accumulated depreciation in the credit direction, and then the 98,000 minus that 988,335 is going to be the book value of the 88,166.50. If I match that to the depreciation schedule, I'll say, well, does that make sense? And it's going to say, yeah, I've got the 98,000 is the total. Well, let's calculate the accumulated depreciation. 7,500 was last year, plus, let's do it this way. We got the 14,001 divided by 12 times 2. That's current year depreciation thus far, plus the 7,500. That's last year's depreciation. That gives us the 988. That's correct. And then we can also look at this in total. So if I go down to the bottom, the two categories added together are typically displayed. And if I want to just double check it at total, we have the 103,000 for the total fixed assets. If I select, that's going to be this item and this item. Adds up to the 103. That looks good. And then the accumulated depreciation total should be this would be for the year, total for the year, 14834 divided by 12 times 2, that would be our 2-month time period, plus the prior year of 7500. We've got the 9972, which should tie out to our accumulated depreciation here and here, which would be the 997223. So that looks like it's working out now. So that decreases the book value here, and of course increases the expense in a similar way as we saw with insurance expense. And you can see how once we have this schedule, we can just do a pretty simple journal entry. It's just you got to work out how are you going to deal with creating that schedule. So next time we'll just enter this into QuickBooks, and again, once we know what the journal entry is, then the entering of it into QuickBooks is not too difficult. The difficult part is how are you going to work out the schedule, how are you going to set up the system, how are you going to deal with tax depreciation versus book depreciation, and then once you set up a system like this and just record in the journal entries, the actual journal entry should be straightforward, and that's what we'll do next time. And when we do it, we'll tie out then our accumulated depreciation, our book depreciation, and we'll tie out our depreciation expense, and then we'll tie out our net income at the bottom line. I'm also going to copy over these accounts. I'm just going to select these and copy them down. So that's what we have thus far for our worksheet.